Hello, I'm Matt Scooby. Welcome to Market Call. Martin Cobb is on the show today. He is Senior Vice President, Equities at Lorne Steinberg Wealth Management, and will be taking your questions on global and North American equities. You can call us toll-free, 1-855-326-6266. You can also send us an email to marketcall@bnnbloomberg.ca. Martin, welcome. Thanks for being here.
Hi, Matt.
On this Friday. Happy Friday.
Yes, thank you.
Yeah, let's get into it, shall we? We talk about, at least for now, is curious in the markets right now, too, as well. You south of the border, it looks like we're going to be in for another winning week, another 8 straight week. You mentioned, though, when I was reading a little bit about interest rates.
Yeah.
So I'm very curious your thoughts of where this is going to drive us here as we get through the summer, through Q2 into the rest of this year. Give me your thoughts and lay it out for us.
Yeah, you're starting to see, particularly with the US 30-year Treasury yield now above 5%. As commentators, on the markets, on the equity side, starting to point to interest rates. We've not really had that for so long. I mean, I remember the time the TINA acronym was kicking around. There is no alternative to equities because of the paucity of yields that we had on fixed interest. And here we are today with 4 or 5% interest rates on long-term, US Treasuries. That's providing some competition for equities, you could argue. Also, it's a cost of capital. It's a cost to households. It's a cost to businesses as well. So those pressures also might come to bear over time. So it's been a long time since we've had these interest rates.
Yeah, which is interesting. I know. And we've talked about this, and we're slowly starting to see those pressures. Clearly, with where inflation is right now, some of the latest numbers that we have seen, too, as well. How do you see that, and what other pressures do you see as we get through the summer and then into the fall here, at least in the short term?
Well, I'm in the Ben Bernanke camp. He wrote a paper in 1997 talking about interest rates and oil price shocks. And, what we shouldn't do is really raise interest rates into something which is a really not discretionary spending, in terms of how oil comes through and impacts the economy. And ultimately, if you look back at some of the previous oil shocks, the rising of interest rates to stem inflation were actually ended up being quite deflationary. What you're seeing is long-term yields rising, which really has nothing to do with what rates are going to be in the next little while. And I think that's a greater concern amongst investors in bond markets about maybe not the solvency of governments, but the credibility, of governments with record high deficits, record highs outside of war times, and those sort of factors starting to play into investors' minds. So I don't think it's just short-term inflation or short-term interest rates. I think there's something here is a little bit more sinister.
Before we get into the rest of the calls and otherwise, new Fed chair in the U.S., right, coming in, Kevin Warsh today. So at least officially being there, what impact do you think that's going to have in part of this interest rate conversation, but now broader as we talk about some of the U.S. equities, the U.S. economy?
Interesting question, because we've all talked about Powell and how much a certain individual wanted to get rid of him. But the Fed governor's 1 vote in 12. It's not that big a difference. Now, there's arguably other changes could take place over time. So we have a more, shall we call it pro-administration, type Fed. I'm a big fan of independent central banks. Any kind of jeopardy on that, I think, would be a bad thing. Will Kevin Warsh make much difference? Maybe at the edges. But ultimately, he's one individual amongst a dozen. And that dozen, hopefully, will have the independence of thought to decide what's right for interest rates.
Yeah, we will certainly see the impact of that. Okay, we're going to be back with Martin Cobb of Lorne Steinberg Wealth Management, taking your questions on global and North American equities. You're watching Market Call. Let's get into some emails, and we'll start taking some calls shortly. What's from Peter? This is an email that comes in. It says, "Hi, Martin. Would you add to PPL at today's price?" Thoughts?
I like pipelines. As businesses, I like pipelines a lot. We own TC Energy. You've got a local monopoly, huge barriers to entry, arguably impossible barriers to entry, contracted cash flows. Lots to like about the business. The problem is today, that's not lost on investors. So you take Pembina or TC Energy, historically you pay a multiple in the teens on earnings and you get a 5%, 6% yield. Today for Pembina, you're paying 22 times forward earnings, 4% yield. A lot of that good news and the attractions of the business, I believe, is in the price today. There's a term halo, I don't know if you've heard about, heavy assets, low obsolescence. It's stuff that's kind of impenetrable from AI. AI can't really replace pipelines last time I looked. And I feel that investors have kind of moved into those types of stocks as well as the AI type stocks, arguably a little bit too much so. So in terms of buying it today, I would probably back off from that. I'd be more of a trimmer and a seller of the pipeline businesses with a view we make it an opportunity to buy them at valuations that are considerably lower than where they are today.
Okay, yeah, certainly interesting. I haven't heard of Halo, so that's good to know. Always learning something. Let's go and take a call, shall we, too? We're going to talk to Elliot in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. Banco, I like the CEO's laser focus on profitable growth, cutting out geographies and product lines that just aren't making money. What are your thoughts on SAN going forward? Thank you.
Thanks, Elliot.
Yeah, as a former banks analyst and also as a portfolio manager at Templeton, we spent an awful lot of time discussing European banks. You go back a decade or so ago, there was existential risk about European banks. And then you look the last couple of years, they've been some of the best performing stocks globally. And that reflects where valuations were back then. So I agree with the viewer in terms of the attractions of the management's focus, the geographic footprint not being sacrosanct. They will shut down or open up wherever they like to be. But I just do worry a bit about valuations in the sector generally. So European banks are more expensive than they have been in a decade, and Santander is no exception. So, like the business, maybe be mindful of your position size and recognize that it's fairly fully priced, and it's still banking. It's still a cyclical industry, lest we forget.
Right, and always it feels like more cyclical maybe than others, clearly. Let's go to Frank now, who is in Calgary for us this afternoon. Frank, go ahead.
Yeah, good morning, guys. Thanks for taking my call. I really appreciate it. Martin, I'm interested in picking up some tourmaline oil and gas. This is the most important part of this question. What would be a good entry point? What's a good price? Is it now, something lower? Give me an idea, please. Thank you very much.
Thanks so much, Frank. Always a good question, too, as you get into that point.
And a really simple answer, buy at the low point. No idea what that would be. No, it's a tough question because obviously in the short term, what happens in the Middle East and therefore what happens to oil prices is going to kick these stocks around, quite somewhat. We own, CN, Canadian Natural Resources. We like it because of its low break-evens. So it doesn't matter if oil price is 100 or goes back to 80 or 70, they'll still make an awful lot of free cash flow. So I'm going to probably fail in terms of answering this question. I don't know. You should have a long-term view. Maybe take your time and buy some, in the next little bit, some a few months later, and some, over maybe a 6-month period. That would be my best advice. Probably not the answer he was looking for, though.
And then keep looking at it and keep checking in, right, at different points?
Just in terms of timing your purchases.
Yeah.
And I say this to my kids when it comes to just investing in their ETFs for their retirement. Don't put all your money into the market in one go. Take your time. Just average in over a period of time. And given what's happening with oil prices, who knows what the oil price might be next month or next week? I would say take your time with this one and buy a position over the course of several months.
Okay. Let's go back to the phone lines, shall we? And Jim is in Chatham, Ontario. Jim, go ahead for Martin.
Thank you for taking my call. I'd like to know what Chartwell, if it would be a decent price to buy it today. Thank you.
Okay, thanks for that, Jim. You can see the chart on Chartwell, too, looking had a decent year in the last year or so, up over 16%. But thoughts, Martin?
I like the industry, and they're obviously a leader in the industry. You look at, we're all graying, we're all getting older. The health provisions or retirement provisions from the public sector are really declining around the world. And so, private retirement, care homes, etc. Long term, I like that industry. They have a great brand, because in theory, anyone could open a retirement home. Who wants to come to Martin Cobb's retirement home? Not sure many would. So I like them. I would think it's one to think about the long term. I mean, they obviously think about the long term as a business. And I would say it's not a bad place to have some money parked over 5 or 10 year view.
Can't imagine it's a super competitive sector, right? At least you talk about being at the top of it, but is there a little bit of competition there?
Yeah, there is some competition. And again, I mean, if you open a retirement home, it's all about the branding. If people want to trust you. And how do you build that? You have to do it over years. And you have one bad, scenario happens in one of your homes, you can lose a lot of that cachet. So given their, quality, seen as a quality offering, the demand for their product, as long as they don't drop the ball, they should be very well positioned.
Yeah, interesting. Okay, we have an email now. This one comes in to us from Patricia. What do you think about BCE? I've been holding for a few years, wondering if I should take my losses or wait. And we should say that BNN Bloomberg is a division of Bell Media 2, the parent company, and Bell is the parent company of Bell Media 2. So thoughts on BCE 2 as it's been tough years at different points, but what are your thoughts on that?
Well, I like the nature of the question. So I'm going to throw back a question. Say, if I gave you that same amount of money today, would you buy BCE stock? Because we are plagued by biases as human beings, and as investors, no more so. It's absolutely the case that we are affected by what we did in the past. So there are two biases: endowment bias. We value something more that we own than we don't own, and regret aversion. Oh, I don't want to sell this because we're going to make losses. You're basically admitting you made a mistake. So think about it. Would you put the money in there today? That would be a better way of approaching that than saying, oh, should I take my losses and move on? With BCE, and answering the question, the world has changed. I mean, the cozy oligopoly of telecoms up here with strong population growth and premium pricing has come to an end. Now, population growth may come back, the competitive environment may improve, but that's by no means a dead cert. Now, you're getting a 5% dividend yield, but every time the company pays a dividend, the share price goes down, so don't be too attracted to that. The valuation today at 12, 13 times earnings, maybe that valuation compression is over, so you'll get your dividend yield and not have capital losses. But in terms of long-term compounding of wealth, it doesn't strike me as a stock that really I would want to have over the very long term. So we do own it, but it's one that is on a very short leash, and ultimately we would look to recycle into something else.
Yeah, and that would be the same for the rest of telecom, especially in Canada too, Martin, at least as you touched on that sector too?
Yeah, they've all got similar problems in terms of lots of debt and over-distributing. I think the one that I find most attractive today is Rogers, because they've got the crystallization of the sports assets, which they have a very clear plan on how to do that. And as we know, I'm a Chelsea soccer fan. I mean, the price that individuals will pay for soccer franchises or sports franchises is ridiculous. So if they can get part of that, get it fully consolidated and spin out a part and get a valuation attached to that part of the business, I think that could crystallize quite a bit of shareholder value if they do it.
Yeah, and again, they have been increasing that significantly too, in that part of for the company too. Okay, we're going to take a short break, and we'll be back with Martin Cobb of Lorne Steinberg Wealth Management, taking your questions on global and North American equities. Stay with us.
I think I've been on the show.
We're back taking your calls too and your emails too for some stock picks with Martin Cobb. Let's go to another email too. This one comes in from Bill. Bill says, I would really like to make a large long-term investment in the Royal Bank. Your thoughts, please. Thanks so much for the email, Bill. Canadian banks too, Martin, as we talk about this, and we're the go-tos, it felt like for a long time in this country. But your thoughts on Royal Bank, maybe, and we'll get to the rest of the sector afterwards, but give me your thoughts on the Royal Bank to start.
Yeah, we own Royal Bank, have done since we launched our Canadian dividend strategy back in 2020. And we've been overweight the sector most of the time. But today we're taking money off the table in the Canadian banks. Why? Because of valuation. I mean, Royal Bank today is trading on I think 2.6, 2.7 times forward book value. It's the highest we've seen since prior to the global financial crisis. And the business hasn't really changed all that much. So I'm a bit concerned when you said making a large long-term investment in Royal Bank. I would take your time to invest in it, because you may be buying, well, in fact, you are buying the stock at one of the highest valuations we've seen in 15 years. So I'd be mindful of your timing on that. Yes, Canadian banks are well positioned. It's an oligopoly. They make supernormal profits. It's a great place to be, one of the top banks in this country. But there's a point at which investors credit too much to that attraction, and I feel we're in that kind of camp today a bit.
And so what does that mean now for the next little bit, too? If you're in that camp and what we could see happen here for the next 6 months, a year, a couple of years?
Yeah, well, obviously next week we get results.
Right.
Although you've heard me say on the show before, what can you learn from 13 weeks of trading? What's driving the banks today is the capital market side, investment banking, wealth management. It looks like RBC is going to be on the SpaceX IPO. That can only be, money from heaven kind of thing. But ultimately, the core businesses, we're seeing, delinquencies on mortgages rising slowly, insolvencies picking up. So on the PCL side, the provisions for credit losses side, that could pick up somewhat. And let's face it, capital markets are cyclical. We forget because all we've had is boom times for several years now. So if we were to see a softening in the capital market side and pressures on the economy, again, it's not that these businesses would start being loss-making, but they might not be afforded the same multiple that investors are affording them today.
Yeah, and again, given where we're at too, consumer-wise, you talk about that debt level too. It's certainly going to be having an impact, it feels like, at some point soon. Let's go back to the phone lines, shall we? Mike is in Toronto. Mike, go ahead.
Hey, Martin. I got a question. It was about CrowdStrike, but before that, I just want to get your opinion whether this subsector is even an investable subsector, because it's like a game of musical chairs whereby if a company or a couple companies get hacked, they get taken out of the game, so to speak. And the way things are set up is there's the AI firefighters like CrowdStrike, Palo Alto, and Darktrace, or there's post-quantum AI kind of, shield companies. Like, these are not recognized, but like Quantum Night, Market, QSE, and Evolution Q. So I don't know, like, are the quantum guys investable, or is it totally uninvestable, like, as a complete, subsector of tech?
Appreciate that question, Mike. Thanks so much for that. And laying it out for us, I think, too, for those that maybe not as theirs. But your thoughts there?
Yeah, I mean, whole cybersecurity, it just doesn't seem it's going to go away anytime soon. More online, more communications, etc., all being accessed. The quantum angle is interesting because it could undermine all the encryption we've had since day one. Let's not go there today. But here we have the debate now is, well, hang on a sec, but maybe existing cybersecurity providers are all going to be undermined themselves by large language models coming out. We saw Mythos being not released recently from Anthropic because of its ability to find flaws in security software. I think it's probably swung too much that way. So whether it's CrowdStrike or Palo Alto or that whole subsector, I believe there's still going to be a very big part for them to play. They may well have to, absorb, some sort of large language models into their offering. I suspect they probably are working very hard on that today. And the types of threats that will come along, will continue to evolve over time, and they've proven themselves to be very good at it. So I actually think it's quite an interesting subsector to have some exposure to. And CrowdStrike would be, one of the top choices there.
But just sprinkling almost a little bit too, it feels like dipping into it before we get too heavily invested in it for now, or what?
Yeah, no, I think just the valuations, because we've just been in an environment where anything that's seen as could possibly be affected by AI has been hit really hard. And I'm a contrarian. That sometimes gets me in trouble, but I'm a contrarian, and typically looking when I believe the narrative is overdone, and I feel the narrative is overdone. So I would have some exposure to those names, recognizing those things are moving very fast, but they're not going to disappear overnight. And they too will evolve themselves in their offering to their customers.
Okay. Let's get another call in here before we take another break. Joe is in Sherwood Park, Alberta. Go ahead, Joe.
Oh, good morning. Thanks for taking my call. I was just going to ask you about Stantec. I've owned them for a while, and they did a nice, steady climb there for a long time. And even though they get good quarters and everything, their stock seems to be falling, quite, every month type of thing. I was just going to see what you thought of that company. I'll just hang up and listen. Thank you.
Appreciate that, Joe. And again, certainly has seen the declines that we've seen, especially in the past year or so. But your thoughts, Martin?
Yeah, it's similar to the answer I just gave on CrowdStrike. It's the market's fears that Stantec or WSP, the services will no longer be required. It just doesn't make sense. They have a very physical presence in a number of cases. The engineering studies that they do for their customers, the bodies that are involved. Yes, large language models provide some sort of competitive, threat possibly, but arguably I think it actually is an aid to their business. They'll be able to utilize the tools. So I put that in the same camp as a number of these stocks that the narrative has just gone too far. Stantec, great, well-positioned business, engineering services, high value-added knowledge. Yes, some of that knowledge may be competed away, from large language models, but you still need, sensible people, qualified people making decisions and, rubber stamping the study. And they're as well positioned as anyone. Yeah,
and you like getting in? So you like getting in maybe now too when it's down?
No, I think, again, with a long-term view, because, the next 3 months, who knows? But I think you own this for a 3 or 5 or 10-year view. It'll still be around doing what it does today. And we've forgotten about this whole AI narrative. It turned out not to be quite the business killer that we all thought it was going to be.
Okay, we're going to take some more calls coming up, but we are going to take a short break. When we return, we'll have a look at Martin's past picks. That's coming up next. Stay with us. Well, time now to have a look at past picks and what Martin was picking last year at this time, May 27th. Let's start with Tectonic Industries, rather, at least at this point, which has had a significant return, Martin, here in the last 12 months or so.
Yeah, I mean, terrible name. Like a name from the 70s.
I know.
Tektronix.
Say it properly.
Yeah, yeah. And, but we may be not familiar with the company name, but we're familiar with its products. It's the world's leading power tools business. So they have Milwaukee on the professional side, Ryobi on the DIY side, and a bunch of other brands. They also have some floor care products. It's a very small part of the business, but they include Hoover, which is the very first kind of brand that became a verb. So why do I like Tektronix? I've owned it for donkeys, for years. They are outpacing everyone. They've really taken Stanley Black & Decker, which owns DeWalt's, Lunch, away from them. They spend 3 times as much as that company does in terms of R&D, improving their offering of their products. Really pushed into the battery side, the cordless side. You can get cordless lawnmowers, cordless chainsaws these days. But they've just done a really great job. They typically grow 10%, sales growth a year, double the market, and have enjoyed incremental margin improvement. Cleanest set of accounts I've ever come across. The founding family still involved. They have net cash balance sheet and trades on less than 20 times earnings. If it was in the US, domiciled there, I suspect it'd be on double that multiple.
Which is interesting. And the way it was able to take over that market share, what DeWalt felt like that it really did dominate for such a long time was really fascinating. And you watch that, but likely continuing to talk about the battery power has been a big appeal, it feels like, for this company in particular. Yeah,
I mean, Stanley Black & Decker had other issues with its security side. It's not a focused, power tools or tools business, and seemed to have taken their eye off the ball somewhat, which probably helped. But when you're spending almost $1 billion a year on R&D, and Stanley Black & Decker spending $330 or something like that, you're always just getting your products better. But it's getting that ecosystem. I kind of don't like the word, but you've got professionals. Once they get into that battery system, they get their first Milwaukee tool with that rechargeable battery. The next one is probably likely to be a Milwaukee tool. My garage is full of Ryobi. It's like lime green everywhere. And, I'm going to buy Ryobi next time I'm out. I'm a bit biased because I'm a shareholder. But ultimately, they've just done a really good job in delivering tools that professionals want.
Second one from last year in past pick is Alphabet, clearly part of the Meg 7 too, which has had a very good year for now. Still holding it, and where do we, again, how do you feel now too about Alphabet here at this current in this current state right now?
Yeah, I mean, go back a year ago and Alphabet's search business was going to die. It seems like what we talked about earlier on the show in terms of large language models eating various businesses. Right. Well, the search business hasn't died. In addition to that, they probably have the #1 consumer large language model in Gemini now, overtaking ChatGPT. They have the data center business, which is growing faster than it has done for years. And they have the IT hardware angle with their own TPUs, the tensor processing units, which can do large language model inference particularly. So a lot to like about the business and how it's going. We've not sold any shares yet. The stock is still not that expensive. It's an upper 20s multiple for still anticipated strong growth. But maybe we take some off the table. But we view this as a long-term core holding. Maybe we take some of that money out and put it into maybe the Microsofts or the Amazons of this world, which are perhaps a little bit more attractive. But we like all three.
Okay. The other one, too, from last year past pick is Canadian Natural Resources. We've been talking at least at points, but also had a pretty good year, too, as well. Total return up over 63% here in the last 12 months or so. But where do we stand now here a year later?
Yeah, obviously, I had no idea what was going to happen in the Middle East. Why I liked Canadian Natural Resources a year ago and why I still like it today, although the valuation has moved up somewhat, is low cost, $40 oil kind of break-evens, great capital discipline, free cash flow that they chuck off, pay down debt, distribute to shareholders. Still doing all of that. The difference today is, the oil price is obviously $100 and the share price has moved up somewhat. So still not that expensive, 12, 13 times earnings, 8% free cash flow yield. And if the oil price comes back to $80 or $70, that'll obviously move up in terms of, the multiple. But so it's hard to put marginal dollars in it today, to add to it at this point. Kind of hard given the 50% move year to date or so. But one we'd like to have a full position for the long term, maybe if it's looking to buy it when things settle down somewhat.
Yeah, and that's what I was going to say. Ask you too. It's interesting just we talk about just the situation in the Middle East and just no end in sight right now. If you're looking at, is it just hold off completely and just wait to get into oil or into gas, at least for now at this point? Because you talk about long term, but there's just so much uncertainty right now, and still it doesn't feel like it's going anywhere anytime soon.
That's a really tough question. I mean, it's we have not been putting marginal dollars into the oil sector, and we're more likely probably to take it out because it doesn't feel that $100 is sustainable. We will see demand destruction if prices continue that level. We've seen that historically, and I say we might wake up tomorrow and find that oil price is $70 because everything's been resolved. I have no idea. I mean, I don't think anyone has an idea. So there may be a more advantageous opportunity. I kind of hate saying that because we always want to buy stuff lower and sell stuff higher.
Right. All
we have is today, but today it's hard to really argue you should be putting more money into the sector.
Okay, we're going to take another short break, and we'll be back with Martin Cobb of Lorne Steinberg Wealth Management, taking your questions on global and North American equities. We're going to continue taking some calls and some emails, too, about some picks. Carlos has emailed in. Carlos says, at current valuation levels, would you be buying, holding, or selling? Berkshire Hathaway own the stock, but there does not seem like there is much movement in its range, right? New CEO, you're able, at least at this point, too, but your thoughts on where Berkshire Hathaway stands right now, what are we thinking?
Yeah, we own it. Did feel it got a little bit expensive. Given the kind of return on equities that it generates, it's kind of been low double digit. The valuation was up there at 1.5, 1.6 times book value, has kind of retraced somewhat. And I guess he's making the point about the range there. Greg Abel's an interesting one because he's an operator. Buffett was a capital allocator. And there's an argument to be made that maybe Berkshire Hathaway today needs more of an operator. BNSF, its rail business, isn't a great performer. Geico, its insurance business, has not been a great performer, particularly against Progressive. And so perhaps him coming in as more of an operator of the existing businesses might be just what we need. Time will tell. I do believe the great capital allocation, opportunities that Buffett deployed so well along with Munger are probably not coming back. So, mindful the valuation is still fairly full. And, we will not probably see the great, deployment of capital that we've seen in the past. But perhaps, if we can run the businesses a bit better, it's probably okay. So I would say it's long term. It gives you a nice diversified exposure to a bunch of interesting businesses that could be operated a little bit better, and maybe Abel will be the man to do that.
Because he's shown that he's not afraid to be making some changes right off the bat, right?
Yeah. And I think that's it. I think it's like, I think we all lament, Buffett stepping aside, and Munger as well, who was just as instrumental. But he will have to be his own man. And maybe it's a kind of Tim Cook replacing Steve Jobs type environment. He's no one's going to be the next Buffett, but he doesn't have to be.
Let's go back to the phone lines, shall we? Bob is in Pickering, Ontario. Bob, go ahead.
Hi, how are you doing? I was thinking about dipping my feet into Constellation software. I just wondered what you think about it right now and in the future.
Thanks for the question, Bob. Appreciate it. Right now, you can see the chart too in the last 12 months or so. But Martin, where do we stand to right now on Constellation?
Oh, we've just bought it.
Okay.
To answer the question, and so I it's the I hate how many times I'm going to say the word narrative on
I know,
this.
But it's the best indication too when you're saying that.
Yeah. Look at what they do. They have like 1,000 different software businesses, serving marinas, golf courses, cemeteries, and they buy software businesses. So do you think the price of buying a software business today is higher, lower, or the same as it was a year or two ago? A lot lower. Now, Mark Leonard, who was the founder and obviously the driver of the business, has stepped aside for health reasons, which is unfortunate. But a lot of the power is now down at the business verticals in terms of making their own acquisitions. So I like the roll-up strategy. I think actually it's more advantageous today in terms of ability to buy software businesses at lower prices. And in addition to that, I just don't buy the fact that some owner of a cemetery is going to say, oh, hang on a sec, I can get ChatGPT to do that when the software works. And if anything goes wrong with it, I phone someone, he comes round and immediately fixes it. So I think it's one of the most interesting risk-reward opportunities today, given the valuation today is in the teens. Historically, it's been in the 30s, and the business hasn't changed.
Right, which is fascinating, too, when you think about that, and maybe just the sector just generally, though, too, and you watch how much that drop has happened in the last... What are we accounting for that here in the last little bit? Or is it just a matter of investors just being, pushed away from something else?
I think it's fear. There's Mr. Market, that kind of manic depressive that Benjamin Graham coined. Sometimes he'll come to your door very optimistic and offer you very high prices. Sometimes he'll come very depressed and try and sell you anything. And Mr. Market for the software companies, despite the results from Constellation or Adobe or an SAP, you go across the world, or even a Microsoft, continuing to be good, there's just that fear that their business suffers or faces existential risk. I just don't buy it. And therefore, the risk reward, never say never, but the risk reward is just too compelling.
Yeah, okay, interesting. Feeling bullish on it too, which is good. So let's go back to the phone lines. Nick is calling in from Toronto. Nick, what's your question for Martin?
Yeah, hi, Martin. Thanks for taking my call. I like your outlook on Lululemon. Stocks looks cheap, looks like a good entry point. I'll hang up and listen. Thanks.
Appreciate the call, Nick, too. We talk about some retail numbers, too, as well. Down outside of the price of gas. That's a whole other story that we'll continue to talk about over the course of the day. But let's answer Nick's question first on Lululemon.
It's a tricky one. I've watched Lululemon over the years. I always struggle with the valuation. And here we are where the valuation looks quite cheap, but there's a question over the business. You know, have they lost their way? There's obviously a fight going on with the founder and that kind of stuff, and where the direction of the business will ultimately be taken. According to my wife, you know, the stores, you know, used to walk in, had a great range of athletic gear. Now it's more kind of day wear and stuff like that. They seem to have lost their way in terms of, you know, what exactly they're offering to the customer. So it's a tricky one because I've seen businesses like Lululemon being resurrected. And I've also seen businesses like Lululemon just disappear. And it's difficult to know which one is going to ultimately where we'll go with this. I suspect, though, they still have a good brand that people want to buy, you know, good penetration around, you know, the globe in terms of the products. So they maybe have a better than evens chance of sorting this out. But it is a kind of high risk reward investment because, as I say, over my many years of investing, I've seen businesses like Lululemon just disappear into obsolescence.
Right, and it's been a brand, again, like you mentioned, people have trusted. But how much does that conflict and that turmoil at the top scare investors away? Is that maybe the biggest factor right now or otherwise?
Yeah, I would say, I mean, it will get resolved. This too shall pass. And ultimately, it does scare investors. We've seen it. We saw it with Rogers when they had their fight. Right. I usually view that as a buying opportunity. More often than not, simply because investors are getting scared because of short-term ructions or management issues or board fights. They get sorted out. And ultimately, you know, things move on. So it's not ideal, but ultimately it's added to the downward pressure on the stock, and therefore is making the stock more attractive, not less.
Okay, we're going to be back with Martin Cobb of Lorne Steinberg Wealth Management, who continues to take your questions on global and North American equities. Let's get to our last few questions on stocks for this week. Am is calling in from Ottawa. Am, go ahead for Martin.
Hi there. Thanks for taking my call. Hi, Martin. I just like to get your opinion on Dollarama. Of course, it's down from its peak beginning of this year. And I know they're expanding into Mexico, but they also have, you know, operations in other countries. I just want to see what your thoughts are in terms of risks that the stock might be facing. As this is a good point to maybe build some additional positions or just to kind of stay and hold, because I'm up about 50% on the stock. Thank you very much, and I'll listen to your answer. Bye-bye.
Okay, great, Am. Thanks for the call. Martin, go ahead.
We own Dollarama, have done for several years, but having seen strong inflows into our Canadian dividend strategy, we have not been adding to it in recent times and seen the weighting, you know, decrease. Why? Because of valuation. The stock has done very well. The business has done very well. A lot to like about the business, but we are approaching saturation in Canada. I live just outside Orangeville. Orangeville is 29,000 people. That's 3 Dollarama stores. That feels like a lot. So I know we're close to the total number of stores that the management's talked about in Canada. So they're expanding internationally. That is, again, you know, retailers expanding internationally, more often than not, that doesn't tend to work out well. Although what they have committed in terms of the amount of capital and what they've done with Dollar City in Latin America, so far, so good. It's not a major needle mover, though. I mean, it's about 3, 4, 5% of profits today, and they're into Australia, a very small business there. So it might, over the long term, generate something. But the problem is, Dollarama is no longer 40 times earnings, but still on 30-something times earnings. And it's still Dollarama. It's still a retail business. So it's one that, while we still like it, no reason why it couldn't be on 25 times earnings. It doesn't feel like it should be up in the multiples that we see today. And so we have a longer-term view. We worry less about short-term valuations, but it could just see a couple of years of continued business progress, but the valuation just kind of compressing, and ultimately you don't make much money. So like it for the long term, but I believe there'll be a better buying opportunity today.
Is there somewhere that you would start selling that stock if you watch this international and you watch that international expansion? Is there a possibility that you look at selling it, or are you still going to hang on for the long term?
Yeah, I think because we're longer term than most in terms of our thinking, and great businesses that we come across with high returns on capital, earnings growth, free cash flow. If it ticks all those boxes, then we don't mind the valuation get a little bit excessive. If we were to see major issues with, Australia won't really kick in as a good or a bad. It's too small. In Latin America, that might change our thesis. Or if we see a real kind of maturity happening a bit sooner in Canada than we forecast, that might affect our thesis. But if it's just a little bit rich in terms of valuation, which we kind of feel it is today, we're happy to ride that out typically. But be mindful of our weight. Our weight is one of the lowest weightings that we have in the fund today, having been one of the largest in the past.
Peter is calling in from London, Ontario. Peter, go ahead.
Hi, Matt and Martin. Martin, a few months ago, I bought CRH on the premise that it was the leading company in its field. And since then, it's been going on a downward trajectory. Could I have your comments, please, on what the prospects for this company is and whether you see a turnaround? Thank you very much for your wisdom.
I appreciate that, Peter. And again, over 5% for the year right now. I'm talking about that recent dip too.
Yeah, no, I've owned CRH in the past. We don't own it today at Steinberg Wealth, but CRH based in Ireland, involved in lots of sort of building materials at the rough end, the aggregate end. So they don't own the quarries, but they take the stuff out of the quarry and turn it into the products that can then be sold to builders, merchants, and stuff like that. They had a very good long-term history of running the business well, allocating capital well, but it is cyclical. It is dependent on infrastructure demand. If you look like the UK economy, which is an important economy for them, or even some of the European economies, there's just times are tough. So I wouldn't worry too much about the short term, the pressures on the share price in particular, but recognise it is a cyclical industry, but a good capital allocator, a good operator, so something we like for the longer term. Certainly, but recognise the cyclicality will come and go, and investor sentiment will come and go. You really have to kind of tune those out,
which can be hard.
Yeah,
right?
very hard.
Which can always be difficult when you're watching those numbers, especially the recent ones. Let's go to another email too. This one comes in from Fiona. Fiona says that I wanted to ask what the guest thoughts are on Micron technology. Is it a buy, hold, or a sell? I can hear you reacting already to this, Martin, at least for now. But so you have something to say.
What a place to be in right now in terms of memory. So Micron is a memory provider, and one type of memory, high bandwidth memory, is the memory that goes into data centers that sits next to your GPUs from NVIDIA or your TPUs from Alphabet, and allows them to operate efficiently. And there is such a shortage. Such a shortage. So you've seen Micron be able to, it's sold out for the next year or two, and be able to charge whatever they like. So they're on course this year to make 10 times in profits, 10 times the revenues they made 3 years ago.
Wow.
Not 10 times the profit, 10 times the revenues. But 3 years ago, they were loss-making. If you look at, I think it's 9 or 10 years this century, throughout 25, they've been loss-making. Memory is a hugely cyclical industry. And so we're sitting here today, it feels like it can never end, the insatiable demand. It feels like there could be no supply response, because it is getting increasingly harder to make the types of semiconductors like memory. But ultimately, this shall pass, and at some point, they will revert to maybe not the mean, but some sort of normal profitability, and the stock will look pretty expensive. So, it's hard to sell in some ways because it feels like the story is so good. But ultimately, I would be taking money off the table over the next little while, because you might end up owning a pup that is loss-making again and is valued at an awful lot higher than it probably should be.
Well, especially in the last 12 months. Like if you got in at some point in the last, before 6 months, then you're laughing.
Absolutely. It was up 150% year to date. It's but as I say, 3 years ago, it was low, it was loss-making, and memory's a terrible business. No one thinks that today, but one day they probably will again.
Very true. Okay, we're going to take another quick break. When we come back, we're going to have a look at Martin's new top picks. Stay tuned for that after this. Well, join us Monday on Market Call. Jamie Murray will be on the show. He's president of Murray Wealth Group and will be taking your questions on North American equities. And if you missed Market Call, you can check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to top picks now, too, with Martin. And the interesting one, Martin, as I was going through this as well, we're going to start with McDonald's, too. And the fast food industry just generally, though, too. But McDonald's is your first one. Tell us why.
Yeah, I'll probably have to go and get a Big Mac for lunch. After, every time McDonald's is just McDonald's. Half its business is in North America, half the business internationally. Not a huge amount of growth. It opens a few new stores a year, get a little bit of growth. Maybe 5%. But it's not really a restaurant business. It's actually more of a landlord. So well over 90% of their outlets around the world are with franchises, which they get rent and then they get various licensing fees. So they make 40% operating margins, very high returns on capital. So a lot to like about that. And we've seen all the fads in terms of high protein, low protein, no meat. They'll offer you whatever. It doesn't really matter. Although I don't think the Big Mac is going anywhere. So you're looking at a business that is maybe going to give us, 5% sales growth, maybe a little bit margin improvement, continuing to get 7%, 8% EPS growth. And historically, McDonald's has been in the range of 20 to high 20s, to almost 30 times earnings. Today it's at 20 times earnings. Don't see any reason for that, why it shouldn't be back in the middle of that range. So, you're getting a nice compounding in earnings, probably a little bit of valuation upside, and it's McDonald's.
Yeah. It feels steady, right?
Yeah,
and even in an affordability crisis, too, and you talk about that families are always going to look at some point towards fast food and towards this industry sector in general.
Totally agree. It's classified as a consumer discretionary. I'd say it's a consumer staple. It's not discretionary, in my view. It's just something that, people will continue to go to. And they've done a very good job of making sure that the menu is what people want. There has been a bit of focus recently on affordability because it did get a bit expensive. So they've kind of gone through that. It's something that we need as a Western society.
And any concerns for you, at least on this one, about, as we talk about inflation, as we talk about costs going up, because you talk about that affordability part of McDonald's in particular has been that way. You touched on it, maybe got a little bit caught up at one point. But as we watch the inflation effects kind of roll through the industries here, as we continue to watch what happens in the Middle East, any concerns at all or not really?
It is a challenge. And if you look at the inflationary impacts, they're felt much lower down the socioeconomic, kind of calendar range. So, it is the lower income households that are going to feel the pain, other than the top 1%, don't really care about oil prices and stuff like that. So their particular, group in terms of customers will face more pressures than most. So yes, it is a challenge. It's something they have to work through. It's probably one of the reasons why, the multiple is compressed down to where it is today. So it's not going to go away anytime soon. But McDonald's will be able to work through it. Their buying power, their offering is, competitive, undoubtedly.
And still will remain, feels like that way. Next up is Universal Music Group. Again, certainly an interesting one, not necessarily a popular pick, but take me through your reasoning here for Universal. Yeah,
Universal Music Group is the world's leading recording and publishing music business. It's an oligopoly with Sony and Warner and them. Universal is 1.5 times as big as Sony, twice the size of Warner. It used to ship polycarbonate discs around the world, our CDs, we'd all go to HMV, and now it's basically streaming and subscription services, which has been very nice for both stickiness of customers and margins. There are pressures on the business coming from AI generated, but they're home to like 50 of the, top-selling artists today, massive back catalogue of some of the greatest artists, which you can probably debate who they are, of all time, and the ability to monetize those assets over time. So I think they're very well positioned. Now, Bill Ackman, Pershing Square, has come in as looking to acquire the business, or more accurately, re-domicile it into the US via his SPAC. So it's interesting, not quite sure how that will play out, because there's a founding family shareholder, but he's obviously, recognizing the value and offer as well. 18 times earnings today for maybe something like 10% EPS growth, and in an oligopoly, and a hugely phenomenal back catalogue. I think there's a lot to like about this one.
Okay, that's good to know. The other one, too, that you have on is Brookfield Corp, which is interesting. Talk a lot about this at different points. So I guess the question is, why now? Why now at this point for you?
I've always struggled with Brookfield because of the opacity and the complexity, understanding what the business does. The financials from year to year are all over the place. We first picked it up 2 or 3 years ago when commercial real estate was all the fear, and you were able to basically buy the business at a big discount to realistic NAV, even if you assumed commercial real estate was worth nothing. And today, the big fear is over private equity or private credit. Their biggest asset category is private credit, Oaktree being, the flagship of that. And so the stock has done nothing for the last kind of year and a half, and is back into interesting territory. And in terms of whether it be data centers or nuclear or tomorrow, who knows what, they are so well positioned, given their global footprint, their reputation, and their firepower, to continue to deliver double-digit compounding in net asset value over time. And today we'll be able to buy it at attractive valuation.
Yeah, but too much risk, like you don't feel like, clearly you don't feel like it's too much risk, but at some point, is it going to get to that threshold for you or not?
Let's say we took some profits last year in it,
Okay.
and because it just got a bit expensive, and the discount to NAV had narrowed too close a discount, we thought, too narrow a discount. But today it's back at interesting territory.
Okay, certainly interesting for that. Martin, appreciate all your insight today. Thanks so much for being here.
Thanks.
That I thank to all of you too as well for watching Market Call. We're going to be back on Monday, the next one, but stay tuned with more coming up after this.